Okay, good morning, everyone. Thanks for attending today's webinar titled Navigating Loan Pricing Model Implementation Roadblocks. My name is Andy Morgan, and I'm a director with Forvis Mazars. I've been working with financial institutions for over 25 years in the areas of interest rate risk, CECL, and the topic today, pricing models and profitability models. So again, I appreciate everyone attending today. So here's a quick agenda on what we're going to cover. We're going to first talk about just what the purpose of commercial loan pricing models is. Then we'll talk about what we typically see as implementation roadblocks. Give you an example of pricing models that are not well calibrated and the impact that that might have as you go to roll that model out within your institution. And then we're going to spend most of our time going through what we normally do with our loan pricing clients when we first calibrate and set up their models. So in order to overcome a lot of the roadblocks we're going to talk about, it's very important to have a well-calibrated model. And we're going to take a deep dive into what it's going to take to do that. And then finally, we'll jump back into the pricing model to show you the impact of a well-calibrated model and how we can overcome the roadblocks we're going to talk about, given the fact that that model is well-calibrated. So again, I appreciate you joining. Let's go ahead and dive into the presentation here. So what is the purpose of a commercial and relationship pricing model? So what we find, a lot of financial institutions are really still relying on gut feel to price their commercial loans and relationships. So pricing models are really designed to quantify the pricing decisions you're making every day. They're really a tool to help you in the commercial lending area. They're not designed to replace, the knowledge you have of your client base, your customer base, and your local markets, but it's just a tool to help you quantify some of those pricing decisions. So what they're really designed to do is help you grow your institution profitably by optimizing loan terms with real-time profitability analysis. So not only should they incorporate looking at individual loans, but the important thing in these models is to be able to factor in full customer relationships as well. So most banks, when they implement a model, they're going to price their loan to meet targets that are set within the model. And we're going to talk today about return on equity targets and risk-adjusted return on equity targets. So in the end, really what you're doing here is you're eliminating the fly-by-the-seat-of-your-pants approach that many of you might still be using within your institutions. So what kind of implementation roadblocks might you run into? So let's say you've decided that you're going to, license a model or maybe even build a model internally. What kind of roadblocks do we typically see as we implement models within our clients? The biggest thing is lender resistance. So lenders are oftentimes dialed into really just growing their loan portfolios without much concern about the profitability impact to their institution. You might have some officer incentive comp plan set up that's based on loan growth, and really that's what they're going after. It's just that next new loan, and they're really not thinking about the overall customer relationships. The other thing you run into as you try to implement a model is, it's just another process that you're going to, put in front of your lenders and your credit teams. It's something that they're going to have to go into and learn how to use. And it's just going to take time out of their days to do that. So a lot of times, that's a roadblock that you're going to have to overcome. And then, roadblock number 2 that we're going to talk about heavily today is just the believability of results. So it's great to decide to implement a model. The biggest thing that's going to impact that implementation, though, is you roll the model out, your lenders, your credit team starts using the model, and then they either get out-of-market pricing suggestions within the model. You get questions on, where are these assumptions and return on equity targets coming from? So it's really important that you have a good understanding of the way that you've set up and you've calibrated your pricing model. So, it really helps overcome roadblock number 1. Once lenders start believing the assumptions and targets and that they see that the pricing model can help them maybe be more competitive on their loan deals because they're factoring in customer relationship data and they can believe the targets and the models suggesting appropriate pricing for your markets, that's when you kind of overcome roadblock number one. So, really these two roadblocks are the main things that we see, and they kind of tie in hand. And it's really important, again, to have that well-calibrated model to overcome roadblock number one. So we're going to pause briefly here for our first polling question. And the question is, does your institution use a loan pricing model? So we'll give you a few minutes to answer that. I realize maybe a lot of you on the call today aren't necessarily at financial institutions, and just here to kind of learn maybe a little bit about how pricing models work. That's totally fine. What we see as we continue to go to market with our pricing model is a lot of institutions really haven't gone through the process of implementing a structured approach to pricing. These models have been out in the industry for a long, long time now. A lot of banks have either decided they don't need it, whatever the case may be. So, hopefully through today's presentation, you'll see the value that these types of models can bring to you. So we'll just give this another second or two, and we'll see some results here. Yeah, this is typically what we see. A lot of institutions, especially maybe community-sized institutions, have in-house developed models. That's coming in at 36%. Third-party models at 19%, and then a lot of you, again, on this call aren't really using pricing models today. So let's give an example of, pricing with a badly calibrated model and maybe the impact that that's going to have as you try to roll a pricing model out and get buy-in and overcome the lender resistance roadblock. And to do that, I've captured a screenshot within the presentation today, so you'll have that as a takeaway. But I want to dive over and actually show you interactively kind of how a pricing model works, and talk about maybe the calibration steps that would lead to a badly calibrated model. So to do that, I'm just going to share my screen. Give me 1 second here. There we go. So you should all now be looking at, let me just move my other screen out of the way here. Just want to make sure you all can see this. And it looks like that's up, and that's design, and we're looking pretty good. So what I'm going to jump through here is just a quick loan example. The way I've set this loan up, I have a commercial real estate owner occupied product type, and I've priced it with $1 million loan amount at a 7.25% loan rate fixed for 5 years. So very simple 5-year fixed rate CRE deal. Going through payment structure, we have an amortizing loan, principal and interest, monthly payments. I'm accounting for a 50 basis point fee in the fee section. We've assigned an average credit quality to this loan. And then we have some product costs that get assigned. So as we go through the rest of the webinar today and talk about some of the things that go into calibrating these models, the product costs are a big piece of that. So we have an origination expense, an ongoing servicing cost, and a fixed overhead that's being assigned to this loan. So there are really a couple different things that can happen as you implement these models in terms of calibration steps that can go wrong. One would be that the assumptions that I kind of just went through on the product costs and maybe the provision expense that we assign, maybe those are way out of line. That could be one problem that you have. The second problem could be, well, maybe you've gone through a detailed process to come up with what you feel are appropriate assumptions, but you haven't spent a whole lot of time determining the appropriate target levels that you should be setting within the model. And really what I'm going to show you here soon is those should really be tied together. The way that we define all of the assumptions that drive the model results should then lead into the ROE targets that you use within the model. So what we see in this example is the way that I've set this loan up. It's calculated out to about a 19.3% return on equity. The targets that have been set within this calibration have a minimum ROE target of 10% and a desired target of 12.5%. So you can see we're considerably above even our desired target. So if I click on what we call our benchmark calculator to show you the impact of that, if we used a model with a calibration like this, what the model's suggesting is we could actually lower our loan rate all the way down to about 6% and still meet our minimum target. If we wanted to hit our desired target level, we could drop it all the way down to 6.39. So, that's probably well below current market rates in your various markets, what would be my guess on a 5-year CRE deal. So again, that could be a combination of maybe our cost assumptions aren't accurate, maybe our provision expense allocation or our capital allocations aren't 100% accurate, or maybe our targets aren't correct. And it could be a combination of those two things together. So what you'll see here is, if you have a model that's calibrated like this, and you roll it out and you start using it, your lenders are going to come back kicking and screaming, saying, can I really make the loan at this low of a rate? And you can also get into the flip scenario where the model suggests loan rates that are way above market, 9%, 10% rates, and nobody believes what the model's telling them. So we're back within our presentation here. All right, good to go. So this again was just kind of a summary what I just went through, and you have that in your slides if you want to review it later. So let's dive into the meat of the presentation here. And what I've talked about all along, the key to a successful implementation is the calibration piece. In order to overcome the implementation roadblocks that you have with your lenders, you have to have a well-calibrated model. So we're going to talk a little bit about a process you can go through to make sure you get to that step. So what I'm going to show you here is what we do is we perform a complete product profitability analysis of all of the existing loans and deposits that our clients have. So this is really going to accomplish two things for us. It's going to allow us to come up with accurate model assumptions. So when we talk about the capital allocations, cost assumptions, things like that, we've gone through a process. We've allocated out bank expenses as an example, and we've come up with accurate assumptions there. That's going to then drive into the appropriate ROE targets that we want to set within our model. Okay, so let's dive into the different pieces that make up our detailed product profitability study. So we're going to talk about each one of these individually here as we go through. The first concept we'll cover is funds transfer pricing. So at the net interest margin level, we'll discuss what funds transfer pricing means and how that might impact how we calibrate our models. We'll then take a quick look at capital allocation and give you some recommendations how you should be allocating capital out to your various products, not only loan products, but we're going to look at deposit products as well. We'll get into the risk-adjusted provision expense and the credit risk-adjusted piece of that. And then we'll talk about both fee allocation and non-interest expense allocation and maybe some best practices there on what you should be thinking about as you go through an expense allocation process. So we'll stop right now before we dive into that and handle polling question number 2. So when we do a profitability study, maybe outside of just Loan Pricing Pro, we oftentimes present what we call multi-dimensional views of profitability. So the question here is, what view of profitability would have most benefit to you? Would it be a loan officer profitability view, branch profitability, customer profitability, or what we call multi-dimensional? Maybe you want to see all views of profitability. So this is another nice thing, if you're thinking about implementing a model, a lot of the vendors out there will offer additional add-ons on top of just looking at individual loans and individual customers one at a time. A lot of times by interfacing your core data into these models, you have some nice features that are enabled that allow you to do some of these higher level reporting views. So you get a nice kind of look at your loan officer profitability and branch and customer and things like that. So give it a few more seconds here. We should see some results pop up. And there we go. Yeah, that's probably good. And what I would have thought would come out of this response, multidimensional. If you're going to go through the process to kind of do an account level profitability study, as long as you have a branch code and a customer identifier and an officer code assigned to those accounts, you should be able to roll all of that up into a multidimensional view. So I kind of agree that that would be the best thing to get if you're going to go through a process like this. So let's dive forward into the different pieces of our product profitability study. The first thing being funds transfer pricing. So what does that really mean? What we're doing here on the existing loan and deposit accounts is we're assigning what we call a cost of funds to the loans and a credit for funding to deposits. And again, what this is going to drive is the net interest margin level of profitability on each of those accounts. So what we typically see here are clients are going to pick a market curve, something like an FHLB curve, a US Treasury-based curve, SOFR swap curve, a lot of different options, but you really want to use a market-based curve in your FTP process. So what that's going to do is it's going to, on a go-forward basis, have an apples-to-apples fair calculation of this FTP rate that gets assigned to each of your accounts. So we have various methodologies built within our model. We recommend using one of the cash flow methodologies that you see down here at the bottom. So you can kind of think of those as, that 5-year fixed rate CRE loan that we looked at initially. I had that amortizing over 20 years. So there's some principal pay down going on throughout the life of that loan. The FTP methodology, using one of these cash flow methods, is going to take that principal pay down into account. So on a 5-year loan, it's not really going to assign a 5-year FTP rate to that cash flow. It's going to really look at the life of that cash flow. The first option here, the coterminous maturity match, that is directly tying that 5-year term to the point on the curve. So it would actually go to the 5-year point on the funding curve to assign the funds transfer pricing rate or the cost of funding rate. So let's just go through an example to kind of explain how this works in practice. So again, we're looking at this 5-year fixed rate deal amortized over 20 years. But what I'm saying here, maybe we want to look at a loan that was originated 3 years ago. So when we go through a product profitability study, obviously we're looking at all of your existing loan and deposit products. So you have loans on your books that you originated at all different times in history. So as an example, let's look at a loan that was modeled or originated 3 years ago. What you're going to want to do in a case like that is not use today's market rates to assign that FTP rate. You're going to want to look at what the rate environment was at the time you made the rate decision on that loan. So in a process like this, you're going to have historical curves built out. In the example here, I just have a treasury curve-based FTP methodology. And really what's happening on this loan that was originated 3 years ago is look at the difference in the curves here at the bottom versus when I developed the slides kind of in mid-August. Now, we've had some movement in the treasury curve, obviously, in the last month, but obviously we know rates over the last few years have gone up dramatically. So when you originated this loan 3 years ago, the cost of funding rate off this FTP methodology would have been somewhere around 67 basis points. And that was corresponding to like the 57-month point on the funding curve. Again, that's using one of those cash flow methodologies. Fast forward to August of this year when our rate yield curve was a lot higher. That same 5-year loan, if you originated it today, would get a cost of funds of about 368. So again, this is going to drive that net interest margin of profitability. We're going to do the same thing on the deposit side. On your non-maturity deposits, we normally look at maybe you've had a deposit study done where we have average life type data on your various categories, non-interest bearing, interest bearing, money market savings accounts, things like that. And we're going to use the average life data and the duration data that comes out of your deposit studies to match up to the same curve that we're using on the loan side. So if you decide to use treasury curve, we're going to use that on the deposit side as well to assign a credit for funding to the deposit. So on the deposit side, we know the rate we're paying our customer. We're going to give that balance a credit for funding through this FTP process. And that's going to define the net interest margin of profitability on the deposits. On term CDs, it's pretty straightforward. A 12-month CD is going to go out to the 12-month point on the curve, and that's the rate it's going to get based on when you either originated that CD or you had a last renewal date. It's very important to always go back to the last time the rate changed on each one of these accounts to assign the appropriate FTP rate. So that's the first part of our product profitability study. It's just that net interest margin of profitability going through an FTP process like that. The next thing we're going to do then is go through a capital allocation. So when you get to using a pricing model, most oftentimes your targets are going to be set on a return on equity or a return on capital basis. And so it's important that we go through and allocate your actual capital out to products. And that's going to be loan products, that's going to be deposit products, and it's also going to pick up what we normally call the treasury management area. So that would be things like your investment portfolio or your other assets, your other liabilities, your borrowing, even your capital account gets a piece here. And so what we do here is we normally start out by looking at the risk associated with each individual product. So on the asset side, it's pretty easy. We normally, go to regulatory driven risk weightings. So commercial loans being 100% risk-weighted products. We normally apply the full equity to asset or maybe your leverage ratio out to commercial loan products. Now, in this day and age, that if you look maybe just at your book equity being heavily impacted by that unrealized loss on your AFS securities, when we calibrate the models, oftentimes we'll kind of take that piece out. Maybe we're looking at more of like a leverage ratio, tier 1 ratio to allocate that capital out. But an example here is, I went through a study recently with a client of ours about $1 billion asset size institution. You can see a total asset number here of $955 million. And so we went through and allocated all of their capital out to these various areas. So the commercial loans got about 9.6% because what we were looking at is a total capital number that we want to allocate of about $91 million out to total assets of 955. So that came out to about a 9.61% that we allocated out to commercial and consumer loans. 1 to 4 family being 50% risk weighted would normally get half that allocation. So the mortgage loan area, you don't see exactly half here because there's a mix of products in there that are 100% risk weighted, maybe the HELOCs, or maybe we have some construction loans built within there. So that's just kind of a blended between the full allocation and the 50% allocation. And then when we get to the deposit area, deposits being not very capital intensive, you can maybe even make the argument that you don't allocate any capital out to deposits. But we feel, you have to have maybe a branch network in place, some brick and mortar to support the deposit gathering effort. So there is a level of capital that should be allocated to deposits. What we normally see there is roughly 20% of whatever is going to commercial loans, we allocate out to deposits. So if we have a 10% allocation to commercial loans, 2% would go to deposits. So that's where the 1.92% comes from. And then we kind of just balance everything out to get to the total allocation by allocating out some out to the other products that aren't loan and deposit related, like your borrowings, other liabilities, other assets, things like that, investment portfolio. So at the end of the day, what you want to have is a fully allocated model. And we're going to see when we get to the end of this process, these allocations are going to heavily impact the way we set targets. Okay, so let's jump forward here. And we're going to talk about risk-adjusted pricing a little bit. So when we get into the credit risk adjusted piece of the modeling process, we want to make sure we come up with an allocation of either provision expense, or you can kind of look at maybe your current allowance or CECL calculation to give us a good basis of the way we want to allocate kind of our expected loss on each product. So again, we're following through with the CRE product type. And what I have here is a base provision allocation of 1.25%. So maybe that's the overall allowance that's on this particular pool within your CECL analysis. Within a modeling process, though, we want to be able to risk adjust price as we get into the pricing model aspect. So what we're going to do is we're going to build out a scaling process that's going to adjust that base level of provision either up or down based on the risk that you're taking for each of your individual borrowers. So one of the settings within your pricing model is going to allow the user to select a risk rating. I have an example here where I grab the average credit quality. If I come over to the average factor, what I see here is a 0.8. So basically 80% of whatever our base allocation is going to get allocated to the average risk rating. So what we see here is our 125 gets adjusted down to a risk-adjusted allocation of 1%. This is all customizable. Within our client base, we help them kind of calibrate and make sure these are set up appropriately. But at the end of the day, you want to make sure if you make the exact same loan to do 2 different borrowers of different risk levels, that you get compensated for taking more risk. So if you jump down to a grade 4, you're going to either need more rate, more fees, maybe a bigger deposit balance to get to the same return levels on a grade 4 versus a grade 3. And that's how you should try to calibrate your pricing model. So that's a very important piece as well. Let's next talk about our expense allocation. So this is really could become a detailed process, and it can really get as granular as you need it to be. You can have some pretty expansive expense allocation models. So I'm just going to kind of walk through what we normally do with our pricing model clients as we set up and we calibrate the models for them, and maybe some things you should think about. If you're either doing this internally, maybe you have an expense allocation process set up already, or if you're using a third-party vendor to help you come up with some of the assumptions for your model. Here are some of the things we normally see as best practices as you do this. So I'm going to just follow through on this slide an example of allocating out just one line item off your GL. It's normally the biggest item, the salary and benefit line. So within this demo institution that I have, their budgeted 2024 expense allocation was roughly $17.5 million, okay? So we know we have a pool of dollars that we're going to allocate out to loans, deposits, and maybe some products within our treasury management area, similar to the way we saw with capital allocation and other pieces. So what we normally do is come up with a first level of allocation. You know, how do we want to split this expense, this line item out between loans, deposits, and treasury? And so we have a pretty good background doing this for financial institutions. So a lot of times, you know, we can go to some of the detailed studies we've done and pull some averages out. But if you really want to get down to the most granular level, you should look at each employee and where they're spending their time. So you have a certain pool of lenders, credit analysts, tellers, deposit gatherers. You know, you really have to look at where everyone's spending their time. You know, what percent of your total salary number is made up of those individuals, and allocate it out that way. So you can get very detailed all the way down to the employee level if you wanted to. So as an example here, we've come up with an initial level of allocation. 50% of this salary bucket is going to go to loans, 40% is going to go to deposits, and the remaining 10% is going to be allocated out to that treasury function. Just we'll leave some dollars there. So that equates out to the dollar breakout that you see here. So once we get to that first level, the next thing that we want to do is we want to take, let's say, our loan bucket, and we want to allocate that out to our various loan product areas, okay? So at a highest level, we're going to split our loan costs between commercial loans, mortgage loans, and consumer loans, okay? That would be kind of the three buckets we normally look at. So the question might be, you know, how should we allocate those out to those various areas? A couple of statistics that we normally look at is a percent of balance statistic and a percent of numbers of accounts statistic. So this is a kind of a typical profile that we normally see. If we look at the breakdown of your loan portfolio between commercial, mortgage, and consumer, commercial loan at commercial banks anyways normally has the highest total balance, right? So in this institution, it was about 67%. Consumer portfolio was very small. That was only just about 1% or so. And then we had about 32% in the mortgage loan portfolio. So again, that's just based on total balance. If we look at numbers of accounts, this is typically what we see. You know, commercial loans on average are larger. If you look at a dollar per account size on these various product types, commercial loans are normally your biggest loans. They made up 23% of our total portfolio if we just look at numbers of accounts. Mortgage loans had 59%, and consumer had a much larger proportion because they're much smaller accounts. So 18% of our accounts are consumer. We only have 1% of total balance in consumer. So what we normally recommend to do is really allocate maybe on a blended weighted average of these two statistics. And there's no right or wrong answer on how you would want to do this. As an example, we're going to use the percent of balance as a 55% weighting, and then the number of account allocation as a 45% weighting. So if we weight all those things together, we come up with an overall weighted average of how we're going to allocate our salary bucket, our loan bucket, out to these various product areas. So we have $4 million going to commercial loans, 3.9 to mortgage, and a small amount going to consumer. Okay, so a lot of times I work with the finance area at the institution to make sure they're comfortable with these allocations and these assumptions. Okay, then we take it one level deeper from there. Once we get it out to these main product areas, then we're going to look at the different product types within each of those areas. And I'll get to that screen here in a second. I just want to talk a little bit about the deposit area. So we do the same thing on the deposit side. In this case, we have broad categories like non-interest-bearing DDAs, your interest-bearing now accounts, money market savings accounts, and time deposit CDs. But the methodology is pretty much the same. You know, we have the same statistics, percent of balance, percent based on numbers of accounts. We can come up with a weighting there. And then within the deposit area, normally what we do is we give kind of a scaling factor approach. You know, you might have more cost associated with just in terms of numbers of transactions and other things you're doing with certain deposit product types versus maybe some of your lower cost deposit products. And that would be, you know, normally what we see is that the checking accounts are your highest cost products. Maybe your time deposits, money markets are the lowest level. Okay, so we'll do the same process there, and we get the bucket of deposit costs going to the deposit area. So once we've allocated out to the broad areas, then we look at your individual products. And we're going to bring in total balance by each of your loan products. So what I'm doing here is I'm breaking up our overall commercial allocation to the commercial loan product types. So for this institution, they have about a $500 million commercial loan portfolio. Their biggest portfolio they call commercial term. You can kind of think of these as like probably the CRE loans. Over half the portfolio is that pool. And then they have the various other pools that you see here. We break it down both in terms of balance and the numbers of accounts. And so the total expense to allocate, now this is a little bit different than we saw on the previous slide. The previous slide was just looking at salary cost. This would be the total expense, $7 million that we're allocating to commercial loans after we went through that allocation process on every expense item on your GL. So we've gone from top to bottom, allocated, went through a process to allocate all of those costs out. $7 million we have to commercial loans. So before we get to a final allocation, we're going to break that $7 million between what we call a fixed expense allocation and a variable expense allocation. Now, you can go through a methodology like this. We have other clients that use what we call a direct expense allocation and indirect allocation. At the end of the day, really what we're doing is just splitting up the total expense bucket out into two separate variables, if you will. And ultimately what we get here is the assumption that's going to drive our pricing model as we start using the model on a go-forward basis. And so as an example, on the fixed expense, what we normally do is a percent of balance allocation. So what we have is a 75 basis point allocation based on the size of the portfolio. And that's going to trickle down into the pricing model. As you're pricing loans will get allocated regardless of loan size, 75 basis points of fixed cost. On the variable side, this is going to be assigned more on a per account basis. So, a $200,000 loan and $1 million loan in your pricing model is going to get the same dollar allocation of variable costs. And similar to what we saw on the deposit side, you should set up the scaling of these allocation based on, the perceived cost it takes to maybe originate these loans, service the loans, and things like that. So if you have a much broader, more expansive underwriting process, more time involved to do maybe a construction loan, you're going to assign more costs there through a factoring process like this. If it's more of a streamlined product, the underwriting process is smooth, you might have a lower factor assigned to things like that. So at the end of the day, we're going to pull all this together. And I know this is kind of a small screenshot. I don't know if you're able to zoom in on that at all. But what we get to is a full product profitability summary view. So everything that we just went through in terms of looking at an FTP process, allocating capital, going through a provision expense allocation based on the risk rating of each individual loan. That's assigned in here under the provision column. I didn't talk much about fee allocation, but that works a lot, very similar to the way we went through our expense allocation. On the fee side, if we have fees that are directly assigned to accounts, maybe you have loan fees that we can directly assign to the actual loan that originated that fee, we're going to assign that directly. Anything that we can't assign directly, we'll go through an allocation process similar to expenses. But at the end of the day, what this study is going to give you is, one, it's going to tie out to your financials. So it's going to be reflective of your actual institution. And it's going to drive all of the assumptions that are going to go into your pricing model. So when we talk about expense allocations and capital allocation and the provision expense allocation, it's going to be based on your actual institution. But more importantly, once we kind of prove that out, what it's going to help us determine are the targets we should be setting within our model. So I mentioned at the beginning, the way we go through and allocate all of these assumptions is going to help us determine targets. Well, here's where we see it. On each one of your product types, we're going to come up with a current return on equity number. So the commercial term loan, the commercial term product is going to have a different return on equity, your current portfolio, versus your other products. And what we normally recommend to do is, based on where your current portfolio currently sits, you're going to want to calibrate the targets within your model to account for that. So on this commercial term loan, we have roughly 11% current return level. Well, maybe within your pricing model, you decide to set your minimum target at 11.5 and your desired target up at 13%. That way, as you start using your pricing model going forward, we know where we currently are. If we price our new loans and relationships to maybe get a little bit above where we currently are, maybe a little bit higher to the desired target, we're going to see over time the profitability of that product increase. So, and again, it's all based on the assumptions that we've determined looking at your actual financials, your actual list of products, numbers of accounts, portfolio sizes, things like that. So in summary, what this does, again, it's going to show us the current average return levels, and it's going to allow us to get very specific on your ROE targets. So what we see a lot of clients doing, that was kind of a high-level example of a breakout of allocation. Other things you might want to consider is within each product type, let's take that commercial real estate term product type, you might think about allocating different costs and having different targets based on various approval levels. So you might have defined approval levels based on loan size. That's what we typically see. So lender authority, that might go up to maybe $250,000 in loan size. So those loans are definitely more streamlined. They don't have to come through committee for approval, definitely not to the board level for approval. You should probably have lower costs assigned to those based on that. And ultimately, you're going to adjust your ROE targets based on the cost that you assign there. You get up to loan committee approval, it's more intensive, maybe higher cost allocations there. We're going to adjust our targets based on that as well. And then if you get all the way up to the board approval level, probably the largest loans you're doing, again, we're going to want to take that into account in setting both our cost assumptions and our targets. The other thing to keep in mind is this is not a one-time study that you should be doing. So, if you implement a model, you go through the process to do this, it's great to hit the ground running with a well-calibrated model, but it's also important to stay on top of these assumptions. So a lot of times we recommend to at least take a look at this kind of analysis on an annual basis to make sure, one, your assumptions in your model stay kind of current and make sure they stay calibrated. And then two, we want to make sure our ROE targets are staying well calibrated as well. So it's not a one-time deal where you just put it off on the side and you don't have to do it again. We want to make sure we stay on top of it and repeat that from time to time. So let's go ahead and handle polling question number 3. I'm going to let you answer that. I'm going to grab a drink of water here quick. Okay, so like I just talked about, calibrating these models, it's important to do this periodically. Obviously, if you have some events that happen, maybe you acquire a bank, or maybe you purchase some loans, or maybe you open up a new branch. Those are things to consider. Maybe you need to take another look at your profitability study to make sure things stay intact. So we'll get some results here popping up on the screen. And there we are. Oh, that's great to hear. 45% of you reported that you are taking a look at this very frequently and you are staying on top of things. Smaller percentage aren't really doing it as often. Probably best practice is to get up here with the 45%ers, and then the remainder is the attendees that aren't really using the model. So I'm going to jump back in now to the pricing model. Just give me 1 second to get things calibrated on my other screen. Okay. I'm going to go ahead and share my screen here. So you should now be looking at the model again. Maximize that. So we're going to look at the same kind of loan that we looked at before. Same $1 million loan, same rate. My assumption here was when I initially built out this loan, I was satisfied with my cost assumptions, my capital allocation, maybe my provision allocation. But what I found through going through that detailed product profitability study was my targets for this particular product type were way out of calibration. They just didn't make much sense. So if we model this exact same loan, and we've gone through that product profitability study, and as a result of that study, the return on equity target became now a minimum of 18.5 and a desired target of 21. What we see here with our loan rate at 7.25, we're between those two targets. So if we want to use our benchmark calculator to see what it's going to take to get to our desired 21% target, it's going to show me I'd have to raise my rate from 7.25 to 7.46. So a lot better than what we first saw when we were looking at that badly calibrated model, and it was suggesting rates around 6%. This would be more maybe real-time, up-to-date pricing based on where market rates currently are out near the 5-year point. And it just shows you that, the targets are very important, as well as those assumptions as you build that out within your model. So I want to follow through on this example just one step further, and then we'll jump back into the presentation to finish things up today. But other things you should be looking at within a modeling process after you have it fully calibrated is not just looking at loans by themselves, but being able to factor in customer relationships as well. And what you're going to see and what your lenders will see, and hopefully you can overcome that lender resistance roadblock a little bit better, is when they start using a pricing model and they can factor in and look at customer related data, and maybe that impacts the way they can price the current loan request. That's when they kind of become proponents and advocates of the model, and that roadblock has been kind of taken down, and you're good to go using your model going forward. So what I'm going to just quickly do, I have just a couple example customers built out here. I've just modeled a customer that has a very, very simple relationship. On top of the $1 million loan that I've priced, this customer, you can either think of this as a prospective deposit account, or maybe this is a brand new borrower. Their prospective account, or maybe it's an existing borrower, and they currently hold a business checking account with an average balance of $150,000. Similar to what we saw in the loan, the deposit product is going to have cost assumptions, capital allocation, everything that we saw on the loan side. Well, in summary, what you see here is by adding the deposit product, it took my loan ROE from 1930 to a relationship ROE of 20.94%. So it increased my ROE. I have a profitable deposit account. And if I run my benchmark calculator again and run this for looking at my loan, it's going to allow me to get more competitive on my loan rate. So if we didn't have the deposit account factored in, I would have to increase my rate to 7.46. We saw that a few minutes ago. With the profitable deposit account, I can sharpen my pencil a little bit, get a little more competitive, and I can actually lower that loan rate down to 7.37, apply that within my scenario. And you can see now my results match exactly the desired target that my management team has set for me. I can start running reports. I can come to committee with confidence that my loan's going to get approved because I've run it through the model. I'm meeting the desired target. So that is just a further example of how you can use these pricing models to build upon just loans by themselves and factor in full customer detail. So let me go ahead and stop sharing there and jump back in. Again, there's a kind of a summary of the same loan with the different targets that we set. That's within the PowerPoint you can take as a takeaway today. So that basically is what we were going to cover today. I wanted to bring this screen up. You know, I know a lot of you said initially you have some internal models that you've built. Some of you have some third-party models. Maybe some of you out there haven't implemented a model yet. The model I went through today is what we call our Loan Pricing Pro model. It's a web-based solution that we've been offering in the industry for 25 years now, well-established model. So we do have some links here if you want to find out and learn a little bit more about our model. There's a QR code if you want to schedule a demo, quick demo to see how it works and just kind of talk about in general what a pricing model can do for you. We can walk through things like that. So I appreciate everyone's time today. I think we're coming up on about 50 minutes or so. So the last polling question is going to just pop up. We're not going to have time. We're not going to show any of the results there. I'm going to kind of stay on the line here for any sort of Q&A that I see in the Q&A box. So feel free to stay on the line. But again, I appreciate everyone signing up today. Here's a screen that has a few of the resources, a few of our people that are involved in our product. So that will be at the end of the slide deck as well. So take advantage of reaching out to us if you have any questions or anything. You know, the other thing, if you have a model in place and you just want to talk about some of the concepts we went through today and talk about best practices to help you calibrate that model, feel free to reach out any time, and we can start those conversations. So there were a couple of questions in the Q&A box. I see one in here. Curious on your opinion using ROE versus Rare Rock. So ROE seems to be easier, but Rare Rock kind of includes that variability of so Rare Rock stands for risk-adjusted return on capital. So we're taking that risk piece into place, where ROE is just simply we're going to calculate the return on equity, not really factoring in adjusting for the risks that we're taking. I definitely feel kind of that Rare Rock approach is the best way to go, as we saw through our simple calibration based on risk rating. We really feel like you should be pricing your loans based on risk rating. So you shouldn't be offering the same terms, the same pricing to a grade 2 that you are to a grade 4. So you should definitely be factoring that in to your pricing model's decisions. So a couple more questions that popped in here that I'll answer, and we'll definitely follow up via email if you want to talk about these a little bit more. You know, our pricing model does integrate with loan ops systems such as Salesforce. We do integrate with core systems. So you know, if you have your core system kind of talking to your loan ops system, you know, Salesforce systems such as Encino, that's kind of a popular one out there. It's not going to talk directly to a system like Encino, but we do have a very sophisticated interface process where we're going to extract your core data out. We're going to interface your existing loan and deposit data into the model. It makes it very efficient for your users to come in here. They can search for customers and easily bring their accounts into the model there. So let's see here. So a question about what's your response to lenders who object that they don't know the risk rating when customers want an initial quote. So, you know, the vast majority of your credits are going to fall within probably your most popular risk rating, whether that's a 3 or a 4. What we normally recommend to do is just assume kind of that grade 3 as a default. In fact, every product within our model is going to default to a risk rating. You know, I probably, if they're talking to their customers, you know, you might model the loan within the pricing model at a risk rating 2, 3 and 4 just to kind of see where the range of pricing comes out. And so as they're talking to their customer, maybe you just don't make it a definitive loan rate. You know, you're kind of still in the process of doing their underwriting. You're going to give them a range of rates based on if they fall on that 2, 3, 4 type range. And then as you get through the credit underwriting process and the risk ratings assigned, then you can go back to your customer and say, okay, here's the rate we can offer based on the ultimate credit underwriting process that you've gone through. That's what I would recommend on that one. Let's see. So how are pricing exceptions taken into account? So, I mentioned at the beginning, these pricing models are just a tool that you're going to put into place as part of your overall commercial lending process. They're not designed to be a replacement to the knowledge you have of your customers and your marketplace. There are always going to be, exceptions. So, things that, the nice thing about having the customer relationship data in there is, if you don't have a pricing model currently, maybe you have a standard rate sheet, or, on 5-year CRE deals, you want a rate of X in your current market. And a lender is coming in saying, well, the competitive rate is 50 basis points below that. I want an exception. The nice thing about the pricing model is you can factor in those existing related accounts. Maybe they're a very profitable customer for you. And by factoring that in, that's when you're going to be able to make an exception to that maybe 7.5% rate and get very competitive down to 7. So hopefully this whole idea of, how do you answer exceptions, a pricing model is going to help you do that. It's going to say, all right, here's everything that this customer has, here's their profitability, and we're going to be able to offer X based on the targets that we've set and things like that. Now, there's also some nuance there. You're not always going to go to the 4th decimal place on a pricing model and say, we can't offer the loan at this rate because here's what the model's telling us. You're going to, like I said, have knowledge of your markets. A lot of times what we see is, you bring a customer into the model and maybe the existing ROE on that customer is 5 or 6%. Maybe they're not a very profitable customer to you. And so as you price a new loan for them, maybe the new loan is going to increase their profitability up to 7 or 8%, but it's not at your target of 12 or 15%. So the exception there might be, okay, well, this customer is currently unprofitable. We are adding a new loan that's going to increase their profitability. So we are moving that needle in a positive direction. Yeah, this customer is still not going to be at our target, but we're going to incrementally increase profitability of our commercial portfolio because we're taking steps in the right direction. So that would be another case where you can take some pricing exceptions into account as well. So I know there are a few other questions popping in here. I'm going to follow up with the ones I didn't get to today individually. We have record of who put the questions in the queue there. So we'll reach out to everyone individually with answers to your questions. And if we feel there's a question that would be, pertain to everyone, we'll maybe answer that as part of the emails that come out with the recording on the videos and things like that you get. So again, I appreciate everyone's time. I think there's a closing video that's going to play here. You guys have a great rest of your week, and happy pricing to you.